This morning, bullish daily precious metal price checkers seemingly lived their typical Groundhog's Day of late, with both gold and silver zooming to begin the day, only to have their respective price actions cut down by overwhelming derivative short-side sell-offs, lowering spot prices in the morning. In this video, we're going to look back over the last dozen years or so in the silver market to try and garner a sense of when during the day our most lows in silver prices hit. I assume if you clicked on this video, you're already buying silver bullion, or you're considering to begin doing so for the medium and longer term. This puts you in a growing minority who also likely too believe that silver bullion is a great asymmetric bet, meaning that for the medium and long term, the downside risk for silver bullion at these price points is minimal versus the potential upside to come. Today in 2021, most even high net worth investors typically have low single-digit bullion allocations, if they have any at all. Most people who advise them or manage their money have not lived through timeframes when the fiat currency, stock market, and bond markets lose tremendous value to precious metals like physical silver and gold. Before we go into the last dozen years of average daily silver price smash data, have a listen to Paul Tudor Jones, who spoke on CNBC this summer 2021. He's a speculating multi-billionaire who cut his teeth trading during the 1970s commodity bull market. Have a listen to his simple view of now versus 2011, the reasoning for how general commodity markets could double and triple in values in short order, given the new secular inflation we are now collectively experiencing.
So I look at $88 trillion of assets under management by asset managers. Of that, $670 billion are invested in commodity indices. That's about 0.75%. If I rewind just to 2011, when inflation was peaking at 3%, not CPI at 4.9, those same investors had 1.2% of their assets, which would imply today, if they just got back to weight, another $400 billion of buying in commodity indices, that GSEI or BCOM would double or triple. And I look at the balances in a variety of commodities, and they're all so razor thin. They're all so razor thin. And this is just what happens if institutional money would get to where they should be, given the level of real rates. What happens if the Reddit crowd ever gets into commodities? God forbid if the bullies, the financial markets, ever were to take it on.
Later in this video, we'll explore what Paul Tudor Jones meant by the bullies of the financial markets, and we'll document some recent financial history in which he himself was in fact a bully in the largest traded commodity market in the world. In this video, we're going to look back over the last dozen years or so in the silver market to try and garner a sense of when during the day our most lows in silver prices hit. Hello there, on behalf of SDBullion.com, this is James Anderson. Before we go further, please smash the like button so other sound money stackers can also see this content. And be sure to subscribe to our SD Bullion channel so you can get our latest market coverages and also a chance at winning incredible bullion giveaways like this one.
You know the drill. SD Bullion is giving away a box of 500 new 2021 Silver Eagles that could have your name written all over it. But if you don't enter, it could go to someone like Silver Steve here. And while we like Silver Steve, he really doesn't like to share. So click the link below for your chance to win.
Click the link below to enter your chance at winning this 2021 SD Bullion Type 2 American Silver Eagle Coin Monster Box giveaway of 500 Silver Eagle coins. Official sweepstakes rules can be found at www.sdbullion.com/sweepstakes. Good luck to all of you who enter and for your chance to win. In the show notes below, I'm going to leave a link to a LinkedIn article I wrote years ago which illustrates back-tested data, proving that having a prudent bullion investment allocation when living under a full fiat currency regime has made mathematical sense over the last 50 years of time. Go read it for more insights and share it with those who don't believe it after you watch this video. Here we're going to cover what time of day has historically been the best time to catch intraday silver trading price lows over the last dozen years. We'll cover lots of silver price charts, so don't hesitate to press pause to study in more detail all that I'm about to show you. Of course, even if the spot price has risen since the making of this video, the very fact that you are fiat US dollar cost averaging into a prudent bullion position separates you from most people who might foolishly believe that fiat currency paper notes and digits on a screen are going to somehow be solid stores of value in the coming tumultuous, likely inflationary decades ahead. We'll begin this video by illustrating that for the last 40 years of time, silver has been a price discovery market of regular interventions, systematic price suppression, and divergence in intraday pricing. And why would anyone want to get involved in a systematically suppressed price discovery market? Well, it's because of what I'm about to show you that silver bullion is currently cheap in real terms versus other asset classes and commodities. But market value riggings often have violent backlashes in the opposite direction. And our belief here is that silver is setting up for one of the most violent exponential movements in value rising ever recorded in history. This chart here shows the silver price from 1970 until now in 2021. It begins with silver priced at $1.92.5 per troy ounce. The red line illustrates the New York opening silver price, which is essentially the spot price for the last more than 5 decades of time rolling. The blue line shows the opening aggregated or added up price for silver trading outside of the New York COMEX trading hours. And yes, you're reading this correctly, silver spot is still hovering around 25 an ounce, while outside COMEX hours it's ballooned to nearly 230 an ounce over the last 51 years of time. Here we will next move to a logarithmic chart in the same silver price data. This logarithmic chart takes percentage changes into account, and by doing this we'll be able to see the black line below, which shows silver's price aggregated inside of New York COMEX silver trading hours. Beginning again in 1970 at $1.92.5 per troy ounce, the current added up price for silver over the last 51 years during New York COMEX trading hours is now a whopping 21 cents per troy ounce. This consistent inside-outside COMEX silver trading hours price divergence is the opportunity in silver at the moment. And while it may take a few more years to revert in violent fashion to the upside, shortages of fine silver bullion at reasonable price points anywhere near spot price are likely to continue until the spot price finally begins climbing and eventually beyond its seemingly ancient 50 per troy ounce, still record nominal price high. Let us now take a look at this inside-outside COMEX silver trading hour price divergence, which it has had 5 distinct eras over the last more than 5 decades of time. It's always been resolved with a rapidly escalating silver spot price, and my contention here is that the 5th current ongoing price divergence will also be resolved likely near or at a triple-digit silver price denominated in fiat US dollars ahead. Historically speaking, and with hindsight being 2020, when the blue and red lines rejoin, that has been a good time to take profits in silver investments and reallocate that capital elsewhere. For instance, in 1980, selling silver and buying US debt or US stocks would have been a killer trade. In 2011, selling some silver investments and going long real estate and or US tech stocks, etc. The point being, once the divergence closes, moving some profits into other asset classes often makes shrewd investment sense. The opportunity currently is that virtually all asset classes outside of commodities and physical precious metals like silver bullion are in bubble territory. So taking other asset classes and moving them into silver currently will likely prove to be a shrewd trade later on this decade. Now I want to point attention to the black line below and how the 5 inside-outside COMEX silver trading price divergences often get resolved, with a short, few or many year long time span in which the silver shorts on the COMEX get their heads handed to them by the bullish silver derivative and bullion betting longs. You'll be able to see how in all 4 prior convergences, the spot price of silver rose many-fold, and my contention is this 5th convergence will only be different in the outsized performance to the upside we may end up seeing in the years ahead. We'll next focus in on the price divergence era spanning from 2011 to 2020, looking at how silver traded intraday during each year to better understand the times during the trading day in which silver shorts attacked the price to the downside. We'll begin with the year 2011 when silver began the year in the mid-20s and ran to a peak of 50 an ounce by late April 2011, only to end the year just below where it began. Here's how silver traded intraday averaged throughout 2011. What you notice in the next 10 years of consecutive intraday silver price charts is that silver tends to fall most during the London AM and PM gold fixes into the London PM silver fix and during the lowest trading Globex hour connecting the COMEX close with opening of Asian trading hours. What will also become obvious to you is over the next 9 charts that the price of silver has mostly fallen during London and New York COMEX trading hours, while it's risen overnight in Asian trading hours. This inside-outside COMEX silver price trading divergence was also obvious with the over 50-year price charts that we started this video looking at. Here's the 2012 silver intraday trading averages. We see a similar pattern, front-running the London AM gold fix, the PM silver fix, and as well a low during the Globex close. Here's 2013. Similar pattern front-running the AM gold fix, the silver fix, as well as the PM gold fix, and another daily all-time low at the Globex hour during 2013. 2014, price rebounded a bit, but we still had lows mainly at the Globex close and even in overnight Asian trading, which is seemingly rare. In 2015, again, London COMEX lows and then Globex low. 2016, similar pattern, this time the Globex is the lowest. 2017, similar patterns, Globex again is low, as well as the AM PM gold fixes. 2018, Globex is the low. 2019, the silver fix and the Globex. And finally, to close 2020, last year we have data on. We have the Globex being the low, as well as intra, the silver and gold fixes on London. Now, if you've been paying attention to the intraday silver price thus far during the year 2021, you'll likely have noticed that the silver prices again often come under pressure in the morning COMEX silver derivative trading hours, for instance, as in today, being an example. The concentrated silver shorts have perhaps been winning battles over the last few months, but I remain confident in the medium and longer term, betting that silver short sellers will again start losing tremendously in this ongoing silver war. Looking back at one of the charts we started this video with, the question remains in my mind how the red and blue lines will again converge later this decade. Will the blue line run sideways, go higher, or fall back to eventually meet the red line? Let's focus in on 2009 and 2010 for the run of silver from the $9 an ounce low to the still seemingly ancient $50 an ounce silver high that has not yet been broken. Looking back at 2009 and 2010, we'll see that essentially the silver price ran from the lowest low of the day when the gold fix happened in the PM from London onward through night in Asia, and even the Globex was set higher than average intraday. So the takeaway looking at this over 12-year long intra-silver day price data is that even in a rising market, there are times when the silver shorts do have an effect downward on the silver price. And my suggestion, these are the hours during the day in which to look for that. And now to close this video, a quick reminder of long commodity bullies to come.
God forbid if the bullies, the financial markets, ever were to take it on.
You see, in the late 1980s, Paul Tudor Jones was a bullion, the largest commodity market in the world, crude oil.
I'm selling the equivalent of about 4 tankers on the opening. You've heard nothing else on OPEC?
No.
I got you.
Thank you, Paul.
Yeah. What do you think of it, JJ? Is this a spot to nail it? I'd rather sell it down, though, than sell it
Betting
here.
that the agreement won't hold, Paul is selling oil futures as fast as he can, hoping that the other traders won't see what he's up to. Speed is everything.
Is 40 bid and a half? Offer 1,000. Offer 1,500 at 40. Offer 1,500 and a half. Show the size. Ask him how much he sold. Give me a number. Tell him more behind it. Do it. There's more behind it.
More behind it.
I can feel it. They're gonna get it. I'm gonna get it. Iraq just said something. What does Iraq say? That's great. They have an agreement between 13 people, but 2 of them said they won't agree, which happened to be 2 of the 5 biggest producers in the world. That was tough to figure out, wasn't it?
Paul is on the phone to an oil trader who's saying somebody's been selling a lot of oil, but he doesn't know who.
That was my buddy at probably, again, the second or third largest crude trading firm. And his guys went, man, these guys, they sold the hell out of it. And the people that he worked with don't know that it was, which is great. That's even better. I hope they think it's some wild as shit Arab who knows the whole agreement's getting ready to fall apart.
Here you can get an idea of just how large oil is compared to all other commodity markets on Earth in present day. So, like the long-term charts we looked at to start this video, over the long run, commodity price rigging and suppression errors often end with rampantly rising values. We're often colluding longs when consistently versus formerly colluding shorts. My suggestion is we are waltzing into one of those eras this decade, and Paul Tudor Jones is simply telling us so in so many words.
I'd have as many inflation hedges on as I possibly could.
In the years upcoming, look for silver and gold prices to climb walls as the shorts get overrun in an increasingly exponential fashion. And acquire on intraday price tips if you have not done so fully yet. That's all for this video. As always, thanks for watching. Take great care of yourselves, those you love.
If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.